Welcome to the Deep Dive. Today, we're unpacking a really strange set of circumstances in global finance.
Strange is one word for it. I'd say it's a profound public contradiction.
Yeah, and it's being carried out by the very people who are supposed to be the guardians of financial stability.
Exactly. So what we're looking at today is this core tension. You have the titans of the financial world, the people who actually run the system.
The household names.
The household names, and they're doing two things at once that just seem to be completely at odds with each other.
Right. So on one hand, you have the public story.
The public story is all about the future.
Yeah.
They are the cheerleaders, the architects of a brand new digital financial system.
They're talking about things like tokenized assets, unified ledgers.
And this thing the Bank for International Settlements, the BIS, calls the Thinternet. It all sounds very innovative, very forward-thinking.
It does, but then you look at what they're doing privately, with their own money.
And that's where the contradiction becomes so stark. Because behind the scenes, they're running for the exits.
It's not just a small move either. It's a coordinated, absolutely massive defensive retreat.
They're liquidating risky assets, they're selling their own company's stock, and they're just piling into the safest, most liquid things they can find: cash and treasury bills.
It really does look like they are preparing financial lifeboats for themselves, and the scale of it, it's just stunning. This isn't just your average portfolio rebalancing.
No, not at all. This is a systemic flight to quality. It's a signal that the people who know the most about the system are deeply, deeply concerned about its stability.
You have to follow the actions, not the press conferences.
Exactly. And their actions right now are screaming preparation for a major event.
So that brings us to the central question we really need to answer for you today.
Mm-hmm.
Why are the architects of this new digital future simultaneously preparing their own financial lifeboats? What do they know about the risks baked into this transition that they aren't telling the rest of us?
And that's what we're going to get into. We need to detail the risks they're shielding against, look at how the digital cure they're promoting could actually accelerate the crisis.
And finally, we'll resolve this contradiction. We'll show you how the cash hoard and the digital push are actually two sides of the very same, very calculated strategy.
It really has to start with the data. And the single data point that I think tells the story louder than any other belongs to Warren Buffett.
The Oracle of Omaha himself.
The ultimate long-term investor. When you think of Buffett, you think of him buying into solid, productive American companies for the long haul.
Right. You don't think of him as someone who just sits on a pile of cash.
Exactly. But that is precisely what he's doing. His company, Berkshire Hathaway, has been hoarding cash and U.S. Treasury bills at, frankly, unprecedented levels.
Okay, so let's put a number on that. As of September 30th, 2024, what are we talking about?
We are talking about total liquidity, that's cash and T-bills, of $320.3 billion.
$320 billion.
It's almost an impossible number to really get your head around, but it's the movement, how he got there, that's so telling.
It wasn't a slow accumulation.
Not at all. In just the first 9 months of 2024, Berkshire increased its holdings of U.S. Treasury bills alone by $158 billion.
Wow.
So that's an aggressive, intentional move into the safest asset on planet Earth. It signals this profound discomfort with basically every other investment opportunity out there.
So where did that capital come from? He had to sell things to get that cash.
And that's the other side of the coin. Over those same 9 months, Berkshire liquidated $133.2 billion in equity securities, in stocks.
So he's actively selling off his ownership in companies to buy up short-term government debt.
That's it. Think about the scale of that. This isn't trimming a position here and there. This is a calculated wholesale withdrawal of capital from the stock market.
So what are analysts saying? How do you interpret a move like that from someone like Buffett?
They're pretty much unified on this. It's Buffett signaling two very clear things to the market. First, he can't find anything attractive or safe to buy at these inflated prices.
He thinks everything is overvalued.
Wildly overvalued. And second, and this is the crucial part, he anticipates a major market correction or maybe even a systemic event that will let him deploy that massive war chest at much, much lower prices.
So he's optimizing for survival now and then opportunity after a crash.
That's the playbook. Survive the storm, then buy up the wreckage for pennies on the dollar.
And this defensive stance, it's not just Buffett, is it? It's not an isolated case.
No, you saw it echoed across the board with corporate insiders, the C-suite executives who are running these massive companies.
Right, there was that huge wave of insider selling early in 2024.
An unprecedented wave. Just in the month of February 2024, you had insiders. We're talking people like Jeff Bezos, Mark Zuckerberg, and critically, JP Morgan Chase CEO Jamie Dimon. They sold a combined $11 billion of their own company's stock.
$11 billion in 1 month.
From the people who have the most information. But the Jamie Dimon sale, that one is. It's the real symbolic dagger here.
Why that one in particular?
Dimon sold $150 million worth of his JP Morgan stock. And for any other CEO, that's a big deal. For Dimon, it was seismic.
Because he'd never sold before.
This was his first sale ever as CEO. Ever.
That's incredible. I mean, this is the guy who steered the ship through the 2008 financial crisis. He's the face of American banking stability.
He is. And for him to decide, for the very first time in his tenure, that the most prudent move is to exchange his own company's equity for cash.
It just crosses a psychological line, doesn't it?
It absolutely does. It signals that even the leader who knows the inner workings of the banking system better than almost anyone believes the immediate structural risks are now greater than the long-term benefit of holding his own stock.
It's the ultimate vote of no confidence, coming from the captain of the entire industry.
Precisely. So you have the architects of the Finternet, this digital future, and at the same time they're retreating to a fortress made of pre-digital, risk-free cash.
So let's look at why. What's the justification they're giving for this retreat? What's the fortress rationale, as we're calling it?
Right. The public narrative they offer is that they aren't preparing for just a typical recession. They use phrases like unprecedented forces.
And Dimon's been pretty direct about this.
He's been surprisingly vocal, yes. He has repeatedly stated that his firm has to retain lots of extra capital and liquidity. Why? To maintain a fortress balance sheet.
A fortress balance sheet. That language is so deliberate.
It's extremely deliberate. A fortress isn't built for a spring shower. It's built to withstand a siege. He's not talking about weathering a downturn where, consumer demand drops 10%.
He's talking about something much more fundamental.
He is talking about a structural dislocation. A scenario where the very foundations of the global monetary system might start to shake.
And has he specified what he thinks the cause of these unprecedented forces might be?
He's been crystal clear on it. He has explicitly cited geopolitical risk as the single largest threat to his company.
Geopolitical risk, that's a broad term. What does that actually mean in this context?
Well, in this context, it's not just about a regional conflict somewhere. It's the threat of the entire post-World War II global order breaking down.
So things like the fracturing of traditional alliances.
The weaponization of trade and finance, sanctions, and crucially, the growing challenge to the supremacy of the US dollar as the world's reserve currency.
De-dollarization.
That's a huge part of it. When your entire banking system is built on the dollar, any threat to the dollar's status is an existential threat to your bank.
And this fear of a monetary breakdown. This is exactly what Ray Dalio has been warning about for years.
It is. Dalio, who looks at everything through this deep historical lens, argues that the current environment, it just feels a lot like the 1930s.
And what's the parallel he's drawing there? What happened in the 1930s?
You had this toxic combination of record-breaking debt burdens left over from the Roaring '20s and escalating global conflict and protectionism.
Okay.
That combination led to the collapse of international trade. It led to competitive currency devaluations, bigger-than-neighbor policies, and ultimately massive political instability fueled by economic desperation.
And Dalio sees that same recipe cooking right now.
He does, and he fears that this mixture will ultimately, in his words, destroy confidence in the US dollar and the bond market.
That loss of confidence is the whole game, isn't it?
It's everything. If the world loses faith in the US dollar and US government debt, which are the foundational risk-free assets of the entire modern financial system, what happens next?
Chaos.
Dalio warns that people lose faith in the ability of money and debt to hold their value. And at that point, the system just breaks.
And think about what that means for a commercial bank like JP Morgan. Their entire business is built on liabilities, deposits, that are priced in dollars.
If the foundation of that currency starts to crack because of all this geopolitical stress, those private liabilities, those bank deposits, suddenly look incredibly risky.
And that's why Dimon's fortress is built with the cash from his own stock sale.
And why Buffett's is built with $320 billion in U.S. Treasury bills. They need assets that are completely outside the blast radius of private commercial bank risk.
It's basically insurance against a systemic, geopolitically driven currency crisis.
Exactly. But here's where the strategy gets really interesting, because it moves from just being defensive to being proactive.
Okay.
They understand the transition to the new digital system, the one they're publicly championing, is, well, it's almost mathematically guaranteed to accelerate and amplify the very crisis they're preparing for.
So the tool they're building is also the trigger.
Precisely. Which brings us to section B, the digital trigger.
The centerpiece of this new digital architecture is, of course, the central bank digital currency, the CBDC.
Right. And the central banks, including our own Federal Reserve, they're positioning this as a necessary upgrade. A modernization to improve payment systems and, counter the rise of private cryptocurrencies and stablecoins.
To head off what they call cryptoization.
Exactly. But if you dig into the internal research papers that the central banks themselves are publishing,
the financial stability reports.
Yes. Those papers confirm a massive inherent instability in the design of a CBDC. It's a paradox. The very thing that makes a CBDC safe is also what makes it the biggest threat to the existing banking structure.
Okay, let's unpack that. What is that mechanism?
It's actually very simple. A CBDC is a direct liability of the central bank. It is the digital equivalent of holding a physical $20 bill in your hand.
Meaning it has zero credit risk. Your money isn't sitting in a private bank that could fail. It's sitting directly with the Fed.
Correct. It is, by its very definition, the safest asset in the entire system, safer than any private liability, including a commercial bank deposit.
So it's safer than money in JP Morgan.
Infinitely safer in a crisis. And to understand why that matters so much, you have to remember how fragile the current fractional reserve banking system really is.
Banks don't actually have all the depositors' money on hand.
Not even close. They keep a small fraction in reserve and lend the rest out. The system only works because there's a certain amount of friction, both financial and time-based, that prevents everyone from trying to pull their money out at the exact same time.
We call that friction switching costs.
Exactly. Right now, if you're a big company and you get worried about your bank pulling, say, $500 million and moving it into a truly safe asset like a T-bill, well, it's not easy.
There are brokerage fees, there are settlement delays, counterparty risk. It takes time.
Right, and those high switching costs create a buffer. They enforce a kind of stability on the system by giving the authorities time to react to a problem.
And the CBDC gets rid of that buffer.
It completely eliminates it. The Fed's own analysis points out that a CBDC would substantially reduce switching costs from bank deposits to virtually zero. It's a seamless, instantaneous, one-to-one digital conversion.
The moment that seamless conversion exists, you've just weaponized human fear.
You put a loaded gun on the table. When the geopolitical crisis that a Dimon fears starts to boil over, or the debt crisis that Dahlia warns about hits, people and institutions will not wait around. The switch to safety will be instant.
And what does the Fed's own analysis say about the speed of this kind of collapse?
Their technical papers are, they're brutally honest about it. They explicitly warn that runs on uninsured or very large deposits could materialize in a very short time.
How short is a very short time?
From one day to the next.
From one day to the next. Let that sink in. A traditional bank run like we saw in the 1930s, you'd see lines around the block. It took days to unfold.
Right. It was visible. The media would cover it. It gave the authorities a window of time to step in with liquidity injections or, declare a bank holiday.
But a digital run driven by zero switching costs, that window is just gone.
It's gone. The crisis accelerates from zero to terminal velocity in less than 24 hours. And the Fed admits there would be little scope for policy intervention. You can't stop it once it starts.
It's the catastrophic design flaw they're willing to accept. They are building a tool that is inherently an accelerator of financial panic simply because it offers this perfect, risk-free alternative to the bank deposits that the entire credit system is built on.
And the damage doesn't stop with just a few banks failing. We have to look at the chain reaction, the knock-on effects on the real economy. It starts with this concept called deposit substitution.
Okay, what is that?
It's what happens when depositors, especially the big ones, corporations, investment funds, rapidly shift their money out of commercial banks and into the risk-free CBDC. that money is being substituted out of the private banking system.
And that drains the banks of their funding.
It bleeds them dry. A bank's business model is to take in those cheap deposits and leverage them to make loans. When those deposits vanish overnight, the bank is immediately in crisis.
They have to find funding somewhere else, and fast.
And all the other options are more expensive. They have to go to the wholesale markets, try to borrow from other terrified banks, or go to the central bank's discount window, which is like putting up a giant neon sign that says, "I'm in trouble."
And this reliance on more expensive money has to have an effect on lending rates.
It's inevitable. The Federal Reserve's own research estimates that this forced scramble for funding would jack up bank lending rates by somewhere between 50 and 250 basis points.
0.5% to 2.5%.
In a time of extreme stress, yes.
That is a massive jump in the cost of capital. And it's not being triggered by a conscious policy decision at the Fed to fight inflation. It's being triggered by a systemic panic attack.
It's a sudden, violent tightening of credit across the entire economy. And that leads directly to the next phase, which is financial disintermediation.
Another technical term. Let's break that down.
It just means the banks stop acting as the intermediary for credit. If their cost of borrowing suddenly jumps by 2.5%, they can't afford to make new loans or even roll over existing ones for businesses. The engine of the economy just seizes up.
So if I'm a small business owner, I go to my bank to renew my line of credit that I use to pay my employees.
And the bank says no. Or they say yes, but the interest rate just doubled. Either way, you're in deep trouble.
The Fed predicted a specific drop in what they call commercial and industrial lending, right?
They did. C&I lending, the loans that literally fuel business operations, is estimated to fall between 1% and 5% during these stress periods. Now, that might not sound like a lot.
But it's huge. A 5% drop in business credit is the stuff of deep recessions.
It is. Imagine a healthy factory that suddenly can't roll over its debt because its regional bank just lost 40% of its deposits to the CBDC in a digital run. That factory defaults. Its workers are laid off. That's what financial disintermediation looks like on the ground.
And those defaults and credit contractions, they lead to distressed asset sales. Assets that were perfectly valued when credit was easy suddenly become toxic liabilities that have to be sold fast.
For pennies on the dollar.
Okay, but this whole scenario depends on people actually using the CBDC. The technology is only a trigger if people pull it.
That's a crucial point. And it brings us to the human element, the psychology of public panic.
Because this efficient CBDC is being introduced into an era that is just defined by global distrust and extreme instability.
Right. These are the human psychological drivers that Dimon and Dalio keep highlighting as the real systemic risk.
We've talked about Dalio's 1930s analogy, the mix of high debt and conflict. But Dimon gets even more specific, doesn't he?
He does. He underlines the urgency, and he traces it directly back to the terrible ongoing war and violence in Ukraine and conflicts in the Middle East. And he also points significantly to growing geopolitical tensions, importantly with China.
So you have this general global anxiety, but at the same time, there's a very specific public distrust of the CBDC itself, isn't there?
A massive distrust. When the Federal Reserve asked for public comments on a digital dollar, the number one concern, the most frequent one raised by citizens, was the fear that a CBDC could enable too much government control of and visibility into payments.
People are worried about privacy and surveillance.
They're not naive. The public is acutely aware that a programmable CBDC could be used to impose political limitations on spending by private citizens or firms. People explicitly warned that a digital dollar could exacerbate existing concerns about privacy and mistrust of the government.
So you have these two incredibly powerful but opposing psychological forces. On one side, extreme fear of government control. On the other, extreme fear of financial collapse.
And that conflict, that tension, is the ultimate catalyst for the very instability the Fed describes.
How so?
Because in a true systemic crisis, that 1930s-style event Dalio warns about, one fear will always override the other. The immediate need for safety will always trump the long-term fear of government control.
Survival instinct kicks in.
Always. When the choice is between watching your life savings or your company's entire payroll get wiped out in a failing commercial bank, or instantly transferring it to a government-controlled but 100% risk-free asset, safety wins every single time.
So the fear of systemic loss becomes the dominant instinct?
It does. And the CBDC, therefore, becomes the tool that converts that generalized macro-level panic, fear of war, fear of debt, fear of the dollar itself, breaking into a quantifiable, explosive, and targeted attack on the commercial banks.
It weaponizes human fear.
It weaponizes fear with the efficiency of modern technology. It turns that global uncertainty into immediate domestic bank runs that happen at the speed of light.
Which brings us full circle. It brings us back to the great contradiction and how to resolve it. We need to connect this digital trigger back to Buffett's $300 billion cash hoard.
This is the endgame strategy.
Right. And the key to solving this paradox, publicly promoting a system that guarantees instability while privately selling your stock, is to see both moves as part of the same plan.
They aren't contradictory at all.
Wow.
They are calculated sequential steps in preparation for the same inevitable structural rupture in the system. They are positioning themselves not just to survive the crisis, but to profit from it on an unimaginable scale.
Okay, so let's walk through the steps. Step 1 is the preparation for the shock.
Right. They're retreating to cash because they see the writing on the wall. They recognize the inherent instability of the banking sector. And they know that the CBDC, once it's implemented, will be the accelerant. It will be the spark that lights the fuse on that seamless digital bank run.
They know this shock will cause a sudden and massive repricing of assets across the entire economy.
Exactly. The credit contraction, the financial disintermediation we talked about, that will force widespread distressed liquidations. Assets will suddenly become very, very cheap, but only for those who have cash on hand to buy them.
Which brings us to step 2, the liquidity shield. This is Buffett's $320 billion.
That's his shield. These massive cash buffers ensure that the key players are completely outside the blast radius of this credit contraction and market volatility.
While other firms are getting wiped out.
While smaller regional banks, over-leveraged companies, and ordinary investors are facing margin calls and forced liquidations, the Buffetts and Dimons of the world are completely insulated. They're sitting on a mountain of risk-free, non-depreciating capital, just waiting
for the market to reset. I remember you said Buffett's reason for selling was that he couldn't find attractive investments at current prices.
Right. His liquidity shield protects him from those inflated valuations collapsing. He's on the sidelines, safe, while the storm rages.
And then comes step 3, the investment thesis.
This is the core of the strategy. That excess capital they're holding isn't just sitting there passively. Buffett himself calls these kinds of cash holdings earnings in store or reserve waiting to be used.
It's dry powder.
It's the biggest pile of dry powder in history. When Dalio's predicted systemic breakdown happens, when the digital bank run hits, credit freezes, and smaller institutions start to fail, the result will be a massive liquidity vacuum.
And that vacuum will force those distressed sales.
We're talking about good businesses being forced to sell off their real assets for cents on the dollar because they can't get short-term credit. We're talking about small and mid-sized banks who can't possibly withstand the speed of a digital run being snapped up and absorbed by the mega banks. Markets will panic. Assets will be sold off in desperation.
And that's when they make their move.
That's when the financial elite, who successfully sold their own stock at the top of the market, remember the $11 billion in insider sales, and who've been patiently holding these vast caches of safe capital, that's when they step in.
They deploy the $320 billion war chest.
To acquire those distressed assets cheaply, just as the system is being transitioned and cemented into the new digitized framework.
It's a classic strategy, but it's being executed on a scale that suggests they aren't preparing for a normal recession. They're preparing for a structural failure of the system itself.
They are. The cash hoard and the technological push are two sides of the same strategic coin. First, protection during the inevitable systemic crash. And second, aggressive position taking for the new financial order that emerges from the ashes.
And we know what that new order looks like. The Bank for International Settlements has been very clear about the goal.
They've articulated the endgame quite plainly. It is to achieve settlement finality on the balance sheet of a trusted public institution, the central bank.
What that really means is moving the core of global finance away from the thousands of fragile private banks, which are prone to these runs and credit crises.
And centralizing it directly onto the central bank's balance sheet. But to get from here to there, you need a crisis. You need a structural rupture that is so severe, it makes that radical transition seem not only necessary, but inevitable.
A crisis too good to waste.
Precisely. And by promoting the CBDC, this technological tool that is mathematically guaranteed to accelerate panic, they are ensuring that when the geopolitical and debt risks finally boil over, that structural rupture will be both swift and overwhelming.
So they aren't just predicting a transition, they're actively preparing to profit from the systemic collapse that forces that transition to happen.
It completely reframes their actions. Their public statements are all about progress and efficiency. But their private actions, their capital flows, are all about anticipating and capitalizing on the coming chaos. They're building a fortress because they know a storm is coming. And in many ways, they help supply the thunder.
It really leaves one final question for you, the listener.
If the world's most sophisticated investors and powerful bankers believe the current system is so fragile that they are liquidating hundreds of billions of dollars to prepare for a collapse that will be accelerated by their own new technology, then how are you positioning your own capital for what's to come?
They are preparing for a new game, and they've already written the rules.
They certainly have.
If you want to understand the true rules of this new game, make sure you subscribe and hit that notification bell. Now, let's dive in.